Fiscal policy is impossible without low or negative interest rates to have expansive fiscal policy. British government debt is 100% of GDP. Currently, it costs 1% of GDP to pay. If interest rates were 5-6%, as presumably opposition are saying they should be, government is saying they should be, that would cost 6% of GDP. That difference, 5% of GDP, is 10% of government budget, because we spend under half of GDP. They are saying they would cut 10% of the budget. How many schools, how many hospitals would be closed to do this? We think it's impossible what they're saying. Their version of fiscal stimulus just ends up being a transfer of money from the government to the rich. Who owns these government bonds? Rich individuals. So again, we also showed how raising rates would have likely led to another recession. Anyway, as happened in Eurozone. Thirdly, we showed a deflationary trap, which again, inflation helps borrowers. Deflation helps people who lend the money. Who is borrowing money in our society? The poor. Who is lending money in our society? The rich. Their side of a house is basically rich people saying, we want to make a 5% return on our millions lend out, not a 3%. This is socialism, communism, horrible. And we showed, contrary to what closing government said, that the response to COVID-19 was helped by low rates. Hospitals are the ultimate long-term investment. The government needs to spend money now and get the return, in terms of less deaths, over 50 years. At a 10% rate of return over 50 years, you need to repay something like 800% of the original amount. At 1% over 50 years, you repay 60%. You see the difference. It's a lot more justifiable to invest in hospitals. Now, why do we take it over our opening? Our opening didn't really have a huge amount. We agree with what they said, that low rates mean people spend more money, and we agree and we support this. But we've shown far better how it happens, how mortgages and credit card debt are variable. Even if they are fixed, they are temporarily fixed. It is very, very, very rare to have a mortgage fixed for 30 years. And this assumes people don't move house for 30 years. Far more likely, you have a debt on 3, 4, maybe even 1 year loans, and then you roll them over and you get the new rate if you don't get it variable. So we're saying people got these low rates very quickly and their interest bills got slashed. Now let me do some rebuttal here. So when they talked about raising rates, when the economy recovers, America recovered a lot better than the Eurozone, in part because they didn't raise rates. The British handicapped ourselves with Brexit and all that business. But the Eurozone did far worse than the Americans. They raised rates in 2012, complete recession again, disaster. The Americans started raising rates in 2018 and 19 because their economy had recovered. It is possible to raise rates. And yes, we concede, even in good faith, Donald Trump did a bit of whining. Jerome Powell and the Federal Reserve still raised rates to 2% because they didn't care what Trump said. We think rates do return to a stable equilibrium in the long run. And when we said, they say lower them in a crisis, because this takes a bit of rebuttal from both gov benches, where they said, opening said you could cut rates when a recession comes around, and closing said businesses are struggling because they've gotten used to low rates. If the rates were high, I rebut to closing, those businesses would have gone bankrupt 5 years ago from having to pay their high interest payments. I say to opening, okay, we can cut rates in a recession and say to someone, now you only have to pay £100 on your mortgage instead of 300. And he goes, but I've already lost my house from having to pay 300 for the last 6 years. Our side of a house gets him the £100 mortgage now and 6 years of reduced ones, or 10 years, or whenever they were talking about raising them. Now, and I've already talked about the key point. She tells most loans are to middle class people. Sorry, we don't buy this. As in, that might be true in a gross sense. But in a net sense, middle class people are savers. Middle class people have pensions. Middle class people keep deposits in bank accounts. Yes, they do have mortgages, but their assets are higher than their debts. For a lot of working class people, that isn't true. So again, higher rates and deflation both help the rich, the middle class, the upper classes, and they harm the working class. This is who government helps. And then we just like to summarize again, you cannot have the government's large spending without low rates. Greece is an example of where someone that tried spending with high rates. They couldn't afford it. And both the financial toll of a Greek recession in 2012, a double-dip recession, was awful, but also the social cost. Schools closed, hospitals closed. These were the cuts. Pensions were slashed. These were the cuts that had to be made to balance the Greek budget because of the high rates Gov are saying they want. Now, because again, the Eurozone raised the rates, ECB. Now, before I move on to closing, I'd like to take opening if they have anything.
So according to the analysis we have already delivered, Italy and Spain have unsustainable levels of state debt, like more than 150%, which damages their credit rating and therefore impedes their spending in times where it is most needed, which is in response to the COVID pandemic, not in like 5 years recovery from the 2008 crisis.
I mean, this would be very persuasive analysis if the European Union hadn't just announced an $800 billion bailout package because rates are zero and they can borrow the money and deal with repaying it in 50 years when it's far less. Japan has government debt of 300% of GDP. The Japanese are doing just fine. As in, when rates are zero, you can borrow pretty much unlimited amounts, is what we've learned here. Now, quickly to government, closing government now. Closing government, I'll take you if you have something. No? Okay. So what we have here is, again, Tom talked about how debts stay in nominal terms. With a high interest rate, the debt just gets higher and higher. We say you lose a debt and you move on. Secondly, they said monetary stimulus leads to inflation. Again, Japan's central bank has printed 100% of GDP, $4 trillion US. Japanese inflation is about 1%. The Europeans, the Americans, the British, we've all had huge QE movements. We have not seen huge inflation they're worrying about. And as we said anyway, inflation just, we want a little bit of inflation. We want 2 or 3% inflation. We don't like deflation. Now, they said lower regulation, reduced taxation could help companies. This is favoritism. This is just meddling in the economy. This is far less efficient than our flat solution. Secondly, just sounds like a recipe for corruption to me. Secondly, where do you get the money from? With high rates, your government can't borrow the money. Where are you getting this money? And finally, they said this led to high inflation in the developing world. The developing world did not cut rates down to zero. In Brazil, interest rates are still double digits. I don't know what they are in Kazakhstan, but I doubt they are 1% or zero, as is what we're talking about. And anyway, as we said again, the inflation just hurts the rich. And I don't know why government is so concerned about the rich. I couldn't care less. Proud to oppose.
I thank the speaker for those final remarks and everyone for what was an enjoyable debate. Please virtually